So we don't actually have to have a recession. We might, but it's not my forecast. I think we'll just slow down but not have a recession. But the period like 2022 of a very strong dollar, that's probably over. But, it could still have small moves up or down in 2023. Oh, we've gone from a period really where things were pretty simple, and that's over. Okay, that is gone. And so I think we're in much more of a period where we really don't know. And that makes us more conservative investors. It makes us more cautious. I do recommend highly diversified portfolios, particularly in this uncertain time.
Hello everyone, welcome to SFC Markets and Finance. As 2023 is coming, we wish to see more certainties. When will the US inflation fall to the Fed's target? Will global recession take place? Will the US dollar continue to be strong? What assets should we invest? Bluford Putnam, Managing Director and Chief Economist of CME Group, will join our discussion. Hello, Mr. Putnam. Glad to see you.
Hello. My name's Bluford Putnam. I'm Chief Economist of CME Group, and I'm very happy to be here today.
I want to begin with the US inflation. The recent data showed that the US inflation seems to ease. What's your predictions of inflation? When will it achieve the Fed's goal?
Okay, yes, inflation is coming down. It peaked in June of 2022. But it won't come down in a straight line. There'll be some zigs and zags, but it does seem to be coming down because basically all of the reasons that inflation went up are slowly being resolved. We had a pandemic where we bought more goods, and that caused some demand for goods to go up, and their prices went up. But the pandemic is over in the U.S., and we're back to dining out and traveling, so that source is gone. We had a lot of fiscal stimulus. $3 trillion worth, and that's not happening anymore. The Federal Reserve has started to raise interest rates and isn't buying assets anymore. So really the things that caused the burst of inflation have been removed. But once you get that burst, it lasts for quite a while. So you have to be patient, but it is coming down.
Will inflation climb again in near term? Why?
I don't think inflation will climb again. It might have 1 month where it goes up a little bit or something, but that's just the data zigging and zagging. We know that housing prices in the U.S. have already responded to the Federal Reserve. Mortgage rates have more than doubled, so housing is slowing down. Rents are coming down. We know that certain sectors in social media, finance, things like that are starting to shed a few jobs. But the service sector, tourism, restaurants, they're doing very well. But on the whole, we're pretty sure that inflation really is on the way down.
Based on current inflation indicators, when will the Fed stop hiking rates? What level will be its terminal rate?
Well, you'll have to ask the Federal Reserve when they'll stop hiking rates. But generally, the federal funds futures market, which is a market that my company, CME Group, runs, it suggests that the highest interest rate will be for short-term rates for federal funds will be around 5%. Might be a little higher, a little lower, but somewhere about 5% is what the market is thinking that the Fed will peak at. And it's a pretty general consensus. And if you listen to what Fed Chairman Jay Powell has said, if it goes a little higher than that, it won't be much. So probably very close to 5% is the guidance we're getting.
Why did you raise the question at 2% rates the new zero?
Well, whenever we've had a recession in the United States, the Federal Reserve has tended to bring rates lower and lower. We had a recession around 1990, and the Federal Reserve took interest rates down to 3%. And then we had a recession in 2000, 2001, and the Federal Reserve took rates to 1%. And then after the 2008 Great Recession, they went to 0%. And the same thing in the pandemic, to 0%. But as we look back over all those episodes and the history of those recessions and the inflation, it looks like that zero might be actually too low. It hurts some sectors of the economy. It hurts savers. It hurts retirees. And it might actually be too low. And so the next time around, and we're talking maybe 4, 5, 6 years or whenever, but if we get a recession that's serious enough, then maybe the Federal Reserve only lowers rates to 2%. So in that sense, 2% is the new zero.
How will rate hikes affect the U.S. real economy directly?
Well, rate hikes first hit the housing sector. So when we started to see the Federal Reserve raise rates in 2022, what we saw is mortgage rates responded. At the start of 2022, mortgage rates in the U.S., long-term mortgage rates, that is, you borrow money for 30 years to buy a house, they were about 3%. Now they're 6.5% to 7%. So they've more than doubled. We slowed the housing market. Housing sales have dropped. Housing prices are a little lower. Rents are dropping. So housing is being dramatically affected already. And that will continue into 2023. So housing is the first direct effect. Everything else is pretty much indirect, and it just takes a little longer to slow the economy down.
How do you think about the U.S. economy in 2023?
Well, a lot of people think that the U.S. economy will have a recession, and they believe that because, well, the Federal Reserve's raising rates, and they also believe it because short-term rates, like if you take the one-year Treasury note, it's yielding about a whole percentage point, a little more than the 10-year. We call that an inverted yield curve when short-term rates are higher than long-term yields. And that's usually a sign of recession. But it doesn't have to happen. In the past, the worst kinds of recessions come when there's some kind of financial distress. Particularly like in 2008, we had the subprime mortgage crisis. Or you go back to 1990, we had a savings and loan crisis that affected the banking system. But this time around, our banking system is very well capitalized, very strong. And we're still creating jobs. So in 2008, a lot of people lost their jobs. They had to sell their houses. It was a domino effect. None of that's happening this time around. So we don't actually have to have a recession. We might, but it's not my forecast. I think we'll just slow down but not have a recession. But we'll see.
So does this mean the U.S. economy will have a soft landing?
Yes, the soft landing idea is that the economy slows down but doesn't actually go into a serious decline or recession. And I am in that viewpoint that that's still very much possible, in fact, the most likely case. But it's highly controversial with the Fed raising rates as much as it has. But you have to remember, when you start raising rates from zero, the first couple of rate rises, in fact, all the way through, I would say, September, if you think about driving a car, you're taking your foot off the accelerator, but you haven't actually hit the brake. It's only right now that the Federal Reserve is raising rates into the area that we would call restrictive, which means they're tapping on the brake. So yes, the economy will slow down, but maybe having an actual recession, we might avoid it.
How about the fiscal policy, since the U.S. will have a separated Congress?
Yes, the Republican Party has a majority in the House of Representatives, and the Democratic Party has a majority in the Senate, and of course, the president is from the Democratic Party. That basically means very little will happen. Because the arguments between the House of Representatives, the Republican Party, and the democratically controlled Senate, they're very partisan. They don't agree on much of anything. And so we're not expecting any new initiatives no tax cuts, no real change in fiscal policy, pretty much a deadlock.
Look broadly, we see the global wave of interest rate hikes. What spillover effects does it bring to the global economy?
Well, one of the big effects of the Federal Reserve raising rates before other central banks, for instance, the European Central Bank really didn't start until late in the summer. And they also started from a lower point. They actually had negative rates. So the first time they raised rates, it was just to get them to zero. Anyway, the Federal Reserve was first. And so that led to a very strong U.S. dollar. But now that the Federal Reserve is getting closer to the peak, it's not quite there yet, but it gets closer to the peak, the dollar has paused. So that's been one really big effect on the global economy. And a strong dollar, or I should say a weak euro or a weak British pound, means that their inflation will last longer. It's like the U.S. has actually exported some of the inflation from the U.S. to Europe and the U.K. I would point out that not all countries have raised rates. The Bank of Japan, for instance, hasn't raised rates at all. They also don't have as much inflation, and that's partly because during the pandemic, they did not have the same kind of fiscal stimulus. So they have a lot less inflation, actually, and they haven't raised rates. So, it's a mixed picture now.
Do you think the ECB and the British Central Bank were too slow to act while combating inflation?
Well, they have a very different problem in Europe than we do in the United States. Europe is right there next to the Russia-Ukraine war. And they have had a much bigger crisis with energy. Russia has turned off the natural gas, which Europe depends on for electricity and heat. Europe has gone to the rest of the world, to the United States for imports of natural gas. They've gone to the Middle East for more imports. So they've done pretty well, but a lot of their inflation is based on heating prices and electric prices. And that is a supply shock, and there's nothing the central bank can do about that. So it makes sense that the European Central Bank and to some extent the Bank of England have been a little slower than the U.S. to raise rates.
Will the deeper recession take place in Europe next year?
Well, Europe has inflation running at about 10%, and it will probably start to decline next year because we've seen some natural gas prices start to come down. We're expecting electricity prices to come down a lot next year once we get past the winter. Have to finish heating our homes for the winter, but we are expecting lower inflation in Europe next year, but it will be higher than in the U.S. It will take longer to come down.
How about Asia?
Well, Asia is really quite different. Countries like Japan only have about 3% inflation compared to the 10% in Europe, the 8% in the U.S. So they're a lot lower inflation. Countries in Southeast Asia, Thailand, Vietnam, other countries like that, they actually have very good growth prospects. They're definitely not in a recession mode. It's kind of a world of several different economies. And if you wanted to look at the fastest growing part of the world in 2023, it's probably Southeast Asia and India.
Which region will have more worrisome economic outlook in 2023?
Well, again, the countries that are raising interest rates, like the U.S., like Europe, like the UK, they're going to slow down. And Europe may even have a somewhat of a recession. But again, if you look at what's going on in India, you look at countries in Southeast Asia, Indonesia, places like that, the growth prospects are very, very good. So it's going to be, Asia will do much better, particularly the Southeast Asia and Japanese economies than the U.S. will for next year.
Now I want to move to commodity. It performed not well in 2022. So is the gold still an inflation hedge? Why?
I don't really think gold was ever an inflation hedge. I think that was a little bit of a misunderstanding, and it comes from the 1970s. In the 1970s, two things happened. Many countries around the world had a lot of inflation. The U.S. had a lot of inflation, but Italy had inflation, the U.K. had inflation. There are many countries had inflation. But what the U.S. had that nobody else had is the U.S. had a whole decade of a very weak dollar. And I think commodities, but gold in particular, were hedges against the dollar being weak, because commodities are largely priced in dollars. Gold for sure, oil is priced in dollars. So you bought commodities during the weak dollar 1970s, but a lot of people interpreted that as a hedge against inflation, which was happening at the same time. But I have a different view. And if you look at what's happened in 2022, as the U.S. dollar got stronger, commodities got weaker. And so I look to the dollar as my bellwether, my primary factor, if you will, to try to understand what's happening first on gold and then on currency, commodities in general.
Will the gold price rise in 2023?
The gold price, well, I don't know where it's going, but gold does not bear any interest. So, and it's denominated in dollars. So as the Federal Reserve raises interest rates, that's a headwind for gold. As the dollar, it's not as strong as it was, a month ago, but it's still pretty strong currency. So I think gold has a lot of headwinds going into 2023.
Speaking of the US dollar, do you think the US dollar will keep strong next year?
Well, that's an interesting question because it's going to have a lot to do with timing. We do expect the Federal Reserve started raising rates before the European Central Bank, but the European Central Bank may continue to raise rates after the Fed has stopped. So we could see the pause in the strength of the dollar continue on because we don't really know where the final rates will be. If the U.S. ends up with higher rates than Europe, then the dollar could gain a little strength. But the period like 2022 of a very strong dollar, that's probably over. But, it could still have small moves up or down in 2023.
If we look back to 2022, we found the oil prices are also an interesting story. We have higher oil prices in the first half of 2022, and now the oil prices are declining. Could you tell us the reason behind?
Well, if you look back at 2022, in terms of the oil price, the first thing that happened was in February of 2022, and oil prices shot very high, $120, $125 per barrel, very high. But then we realized that the oil was still flowing, just not to the same place. China and India started buying more oil from Russia and less from the rest of the world. Then we had the strong dollar, which suggested that, of course, commodities would decline a little bit. And so that's what happened, between the strong dollar and oil production staying fairly high, we had a little weaker oil price. And then we've had these fears of recession and a much weaker economy in China than we expected. So that also led to a lower oil price.
Would you like to say a little more about why China's economy will affect the oil prices?
Yes, China is, in many commodities, China is the largest importer in the world. It's a huge buyer of soybeans. It's a huge buyer of oil, buys a lot of copper. So when you look around the world, China is one of the most important demand factors for commodities. And so we know that in 2022, China's economy hasn't done as well as usual. But if we think it's going to do better in 2023, which I do, then you could have Chinese demand for commodities starting to rise again, and that would lift their prices, particularly in the metals and in the energy sector.
Besides China's economy, what else will affect the oil prices in 2023?
Well, besides China, we always look at production, of course, and particularly the Middle East is probably not going to expand production very much. They're pretty close to capacity. The United States may expand production a little bit. The shale oil in the United States has been expanding, but it's pretty slow. And then we have to figure out what will happen in Russia. And for sure, I don't know. but it does seem like Russia's continuing to produce oil. So from the supply side, it's relatively benign. So I think when we look at 2023, and we have to look for demand changes. And Europe and the U.S. might be a little slower, and China a little faster. So that's what we're really focused on, is these shifts in demand for 2023.
Finally, I want to talk about the U.S. market. The stock market is very volatile this year. Will this trend continue in the next few months as the Fed may stop hiking rates?
Well, it's a very interesting question to try to figure out what the stock market is thinking about, what the market participants all together are thinking. You know, we try to make the stock market into some human being. But what we know is that in the early part of the year, the first part of 2022, as the Federal Reserve started raising interest rates, bond yields also started to rise. And even into the fall of 2022, the U.S. bond yield, say the 10-year Treasury yield, went from like 1% territory to 4%, huge increase in bond yields. And that means bond prices were in a bear market. They were falling. And that meant, you know, knocking on an effect here, it meant that equities had to adapt to the competition from bonds. You know, if bonds are only yielding 1%, equities are the only game in town, so you buy equities. But when bonds are yielding 3.5%, 4%, then there's competition. So the first part of the decline in the equity markets was probably really just related to the rise in bond yields. More recently, though, bond yields have actually declined, and the equity market has still not done very well. So that suggests that now the equity market is looking ahead to much slower growth in earnings in 2023 and 2024. I should also note that different parts of the equity market respond differently to interest rates. The growth stocks, like technology stocks, have a great deal of their earnings are in the future because they're growing so fast. And that means that they are much more sensitive to interest rates. That's just because as interest rates go up, all those future earnings aren't worth quite as much today. So the NASDAQ index has not done as well as the Dow Jones. The Dow Jones is much more conservative stocks. They're more mature stocks. They're not as heavy growth stocks. So once interest rates peak, that could reverse. But we saw a lot of that happen in 2022, where the Dow Jones outperformed NASDAQ. And that's really an interest rate sensitivity cause.
How will a volatile U.S. stock market influence global financial markets? Will they perform better or worse than the U.S.?
You know, financial markets around the world are a very mixed picture. I think for the most part in Southeast Asia and Japan, banks, financial markets are fine. I think in the U.S., they're actually quite resilient. I mean, equity markets have come down, but they're still, you know, we're stabilized. So I think financial markets are in pretty good shape. They're you know, in Europe, there's some countries that have some debt issues. And so maybe there's a little more potential volatility or instability with some of the more indebted countries in Europe. In the emerging market, well, I think countries that have already responded with interest rate hikes, Mexico, Brazil, are actually in pretty good shape. So the global financial system, as I see it, is doing pretty well.
There is an opinion that we are back to the era of cash is king. What's your view?
Well, you know, when cash didn't yield anything, zero, it certainly wasn't king. But now, you know, in the United States in dollars, cash yields more than 4%. And if the Fed raises rates a couple more times, like they said they would, you know, you could earn 5% on your cash. So that's a pretty stiff competition to equity markets who have to worry about high interest rates in recession and things like that. So I don't know if cash is king, but cash has definitely made a big comeback.
Looking forward, would you like to give some advices to our investors?
Oh, you know, we've gone from a period really where things were pretty simple. After the Great Recession, central banks were very accommodating. We had zero rates in the U.S., zero rates in Europe. The central banks were buying assets. The equities were really the best game in town. And that's over. Okay, that is gone. And so I think we're in much more of a period where we really don't know. And that makes us more conservative investors. It makes us more cautious. And going back to your last question, it does suggest that cash might be king in 2023.
What should we invest in 2023? Stocks, bonds, or others?
Well, I don't give investment advice, but I do recommend highly diversified portfolios, particularly in this uncertain time. We have so many things that are different. We have the highest inflation in 40 years in the United States. We have the Fed raising interest rates. We have a lot of climate change issues going on. We have the Ukraine-Russia war going on. If there's any time to be a little more cautious, this is probably it. But I would recommend diversification because we really don't know how some of these things will work out. Our crystal balls are never very good, but now they're almost completely clouded over.
All right. Thanks so much, Ms. Putnam. See you.
Oh, yes. Thank you very much. Well, in the United States, Happy New Year. You still have a little longer to go before the Lunar New Year. But Happy New Year to everyone as we go into 2023. Bye.
As Putnam mentioned, we've gone from a period where things were pretty simple to a period where it's full of uncertainties. This will bring more challenges to our investors. In 2023, we should be more cautious and diversify our portfolios. That's all for today's show. Thank you for watching. See you.